Well, hello, everybody, and welcome back to another broadcast of the Wiser Money Show. Today is July 29th, 2022. Hey, I had just found out from Emma that the last 2 weeks did not populate on YouTube. So don't fret. Today I'm going to double check it. We uploaded it, scheduled it, and for some reason it didn't show up. So today we're going to make sure that it's upline and uploaded and that you have access to it. We're also going to be sending out an email with a link to the YouTube broadcast today. So I don't know what happened with YouTube, but we're back. We're ready. We're ready to go through some things with you. So today we're going to talk about inflation. We're going to talk about unemployment, interest rates, stock market, housing, recession, and our econ map version 9. All right, let's talk about inflation for a second. June 3rd, straight July. Yeah, I can get that out. June 3rd of last month of June. Well, yeah, it's still July. Okay, third straight month of slowing growth, wage growth. Got that out. Hopefully the rest of the show isn't that combungled, but we'll see. Hopefully I can get my mouth working. So 9.1% trailing inflation. Fed increased rates by 75 basis points. What we're looking at is somewhere between a potential 8 to 10% increase in Social Security, as well as I believe that inflation will continue until we start to see a depreciation in savings per capita. We do see some debt increase per capita. I shouldn't say some. It's going up, which is interesting that people are taking on more debt, but they're not spending down some of their saving. Well, let me rephrase it. They are spending it down, but not at the rate that I originally thought. I thought people would be a little bit more reasonable. My bad assumption yet again. But they're increasing debt, which you'll see in a minute with housing especially. And it seems that they're buying retail items and they're traveling. But some of the other things like investing for retirement, building up their savings, that's not happening. Welcome to the new generation. And the government has got to stop giving away free money, which we're going to talk about in just a second. Unemployment. I don't think it's really changed much. We're not seeing any increase in productivity from June to July. And, it was at its worst in December of last year. We were at 49% productivity. By the way, it hasn't been that bad since before World War II. After World War II started, our productivity in our country increased substantially. Fear does a lot of good things for productivity. And 62% is where we're at now, but we should be in the 70 to 75%. So we're still far off. We still have the labor problem. We still have the supply chain logjam. It's just not going real well. And then to add fuel to the fire, before the November midterms that are coming up, we see the Democratic states playing their same old shenanigans like back in the virus times. Let's shut them down. Let's put them under control. Let's make sure that they're enslaved to the government. And this is what we're seeing again. 12 states. Now they're issuing inflation relief checks. You want to talk about killing your labor force? You want to talk about taking away the incentive of people? Make them go to work. I mean, Roosevelt had a great idea. Back before, when they built the Hoover Dam, when they built the road system, he said, there's no such free lunch. You want a paycheck from the government? Go out and build a road. Go out and build a dam. Go out and build the infrastructure. We don't have that right now. I think our government is extremely weak as far as putting people to work and saying, if you want something, you got to give something. They're not. They're basically saying, we're going to give it to you. And that enslaves them even more to the vote. But this is the political side that both parties play, unfortunately. So let's take a look at housing. You'll see where I'm going with this. So in 2019, the median house value sale was $274,000. May of 2022, just a short 2 years later, $414,200. Now look at the difference in the mortgage rates. Back in December of 2019, we had 3.17 in an average mortgage rate. Now it's 5.31. In December of 2019, a mortgage consumed 15.7% of the average income. And the qualifying income then was $50,592. And so you had an affordability index. So the higher it goes, the more affordable it is. The last thing you want is under 100. So there was an affordability index of 159.7. Now look at just what happens in just from 2019 to 2022. pandemic sets in, right? People aren't spending money on other things. They want to change where they live. They move out of the cities. You have massive amounts of people moving out of the cities, moving into the rural areas where there's less housing available. They bid up prices, and the builders cannot keep up with the demand in those rural areas because of the labor shortage. Why? Free money. Therein lies the logjam of the supplies, increasing it even more. So you've got this giant jump of almost $100,000 in just one short year. That is the craziest thing in the world. What does this remind you of? 2006, 2007, 2008 in the mortgage market, in the real estate market. Mortgage rates went from 3.17, they actually dropped, making it more affordable. And then what happened was, because of the supply or the labor shortage, people demanded, with the Great Resignation, more money. So now what's happening is they can raise prices on real estate, but now look at what happens. And this is what if you go back to some of the original broadcasts that I did, I said, those people that are trying to rook the system by saying, I demand more money. The universe doesn't work like that. It never has, never will. You want to demand more, give more. You can't say, I work at Chipotle, so give me $50,000 a year to wrap burritos. And that's what they were doing. Some of these, it's $60,000 to work at McDonald's as a manager, as a beginning manager. So make a long story short. No, look, the qualifying income went from $50,000 to $60,000. That is a massive increase in pay rates. So now your affordability, but see, it doesn't keep up. And this is where the disparity is. The median home income went up more than the income for those that demanded more income. So the affordability index actually went down. Now we push ahead. Oh, I don't know, 6 months, 7 months later, 6 to 7 months later, you go from $365,000 to $414,000, but your mortgage rate goes to 5.31%. Now you're consuming 24.4% of the qualifying income. And look at that. The qualifying income went from $60,288 to $88,000. Why? Because people can sit on their butt and say, I'm not going to work unless you pay me this. And so you have this, the employers have to pay more to continue the operations of their businesses. Why? Because the people can sit on their butts because they're getting free money from the government. But it's going to backfire. It's going to backfire in a big way. And I'm going to make a statement here today, and I'll make it again at the end when I do my econ map. I originally anticipated a 20% decrease in the overbuilt markets. Now, there's 152 metro real estate markets. But what I was talking about in Florida, in New York, in a lot of the rural areas, which have grown quite a bit. In Los Angeles, I don't see that because there's a contained, non-expansive market. But Las Vegas, way greater than 20%. Boise, Idaho, way greater than 20%. But it may get a lot worse than that 20%. As I'm starting to see these numbers line up, and I'm starting to see the debt to per capita go up at a faster rate than what the savings rate is going down, that's not good news, ladies and gentlemen. So let's talk about this whole news cycle that's going on right now. What is a recession? Well, a recession claimed by the majority of the economists is when we have 2 consecutive quarters that our GDP is reduced. Well, do we have that? Yes, we have that. But what does it really mean? I mean, it's a news cycle. It is intended, I guess, to get watchers out of, yet again, fear. But what does it really mean? I mean, does that really affect you and how you operate your individual situation? Well, what is really important? I don't think that this whole determination of GDP is much to worry about. It's, so what if we're in a recession? It has nothing to do with how you have organized your finances. What it does from a macroeconomic standpoint, though, meaning how it affects all of us, not just your economic situation, is we can look at what are mortgage rates doing? What are housing prices doing? What are food prices doing? And then what is the savings per capita versus the debt per capita? That goes back to what you have to spend. If you have to spend more, what does your 3 bucket strategy look like? Now, normally we'll build in a 10 to 15% tolerance, so we've already built in inflation for those first 5 years. That's already built in. But then when we get to the stock portion of today's broadcast, you'll see how your 5-year and your 5 to 10 year or your 10 plus bucket is not really going to, it's not going to matter if we have a recession because it's so far out, these things will cycle and correct themselves. And now we'll get to that. Let's take a look at the Russell 2000. So a couple weeks ago, I put up the Russell 2000 as opposed to the S&P 500. And a lot of people called in saying, yeah, but that's small cap. I want to see large cap. So let me explain what the differences is, and I'm going to actually show you both. There is absolutely no magic potion out there to say, what are we looking like as the stock market goes? Let me explain why. So the Russell 2000 is 2,000 of the smallest stocks. Well, who determines the smallest stocks? And there's different determinations based upon what mutual fund or money manager that you're using. Some of them it's under $1 billion. Some of them it's under $5 billion. So I want to clarify. There is no hard fast rule. When you hear recession, I mean, you could ask 20 economists and half say we're in, half say we're out. It's their definition. So the Russell 2000 is 2,000 of the smaller stocks. What is smaller? Well, here's the difference between that and the S&P 500. The S&P 500 takes market cap. Market cap is the number of shares issued times the price per share. They take the 500 largest stocks. Here's the catch, though. You could look at the S&P 500 and say, well, is it equally weighted? No. See, it's so far off. It's something in the order of 60% of the top or of the movement or the weighting of the S&P 500 is made up of 10 to 15% of the biggest stocks. Google as an example, Apple as an example. So you don't have this equal weighting of 500 stocks to give you a really good indication because it's not equally weighted. You might take the 500th stock and it might only represent 0.25% of the S&P 500. The Russell 2000 is also market cap weighted, but the difference between those two indexes is the S&P 500. The stocks that get into the S&P 500 are voted on by a board of directors. Remember, it's Standard & Poor's is the company, Standard & Poor's 500. And the difference is the Russell 2000 does not use a board election methodology. They use an index admittance methodology. So the point I'm trying to make here is that whichever index you're following, because I got a lot of kickback when I showed the Russell 2000, say, why did you get away from the S&P 500? Because I don't want to peg a decision based upon just the S&P 500 again, because I don't think it's that accurate of an indicator. Neither is the Dow. Equally market-weighted indexes and even non-market cap indexes are a much better indication. But what I'm going to try to show you here is the whole philosophy and methodology behind the 5-year buckets. So if you take a portion, and if you take portion bucket 1, that's not really market related at all, right? It's short-term bonds, it's cash, it's short-term annuities, things like that. If I take bucket number 2, there's about half that's market related and half that's not. But if I take bucket 3, which is the 10 plus bucket, that's all market related. So I'm going to show you why we use that philosophy, that strategy. So here's the Russell 2000, again, 2,000 of the smaller companies in the country, but sometimes that's a better indication. It's a better indication of labor. It's a better indication of productivity because you have a lot more companies, a lot more employees, a lot more sales than you do with segregated companies like Apple or Google. So anyway, here's the Russell 2000. If you go back into 2019, you can see 2020, there's the big drop with the pandemic. And then it comes back in a big way. And we're right back next to baseline of what we were at the beginning of 2020. So if you look at that 2-year period, that segment, and you have carved out a piece into your 10-year bucket, does it really matter what happened in 24 months out of a 120-month measurement? That's what I'm trying to point out. If you have the right plan put together, this whole crazy 2-year methodology doesn't really matter. I'm going to use the same exact methodology with the S&P 500 for those of you that want to follow that. It's a little bit up, but it's 24 months, right? We're talking only 2 years here, and you can see where it dumps, it goes way up, and then it comes back to a little bit above where the average was. Again, over a 10-year period of time, this 24-month period does not have a lot of relevance. Now that makes the presumption that you have in fact divided up your buckets into 3 strategic buckets, and you have reverse engineered your cash flows to make sure that your bucket number 1, which is the 5-year bucket, will meet, even with the inflationary increase, that cash flow for 5 years. Okay? All right, let's move on to the timeline of opportunities. This is my econ map. And if you remember back, the last time that I adjusted this, we went to version 9, was back right after the Russians invaded. And I made some adjustments. That was February 24th. So let's talk about some of the adjustments under version 9. I anticipated that the stock market was going to go up, but I said, hey, right after Russia invaded, we're going to see this bump down until about the end of the second quarter going into the half year. You can see this right on the screen. I don't know if my mouse button will show up in the video, but I'm highlighting, here we are. This was again my econ map that I built out in February. And you can see it's realigning here. We did have a huge dump down in March, April, May, right? And now it's starting to come back. People are now recognizing the war is not the end of the world, and the inflation increase is not the end. The increase in interest rates. This is a lot of the volatility that we see is large hedge funds and large companies like Bill Ackman's Allianz, right? They hedge this, and they hedge it against fear. They hedge it against popular opinion, but it's not real economics. It's just short term, as Warren Buffett says, Mr. Manic, right? He has good day and bad day, and sometimes 6 times in between. So here you can see the stock market returning. My algorithms are showing it returns into September, October, November. And let's go a little further into this econ map. Productivity. Well, I do not believe productivity is going to really increase until they stop giving away free money, until people run through all the free money that they gave them. And you remember what I just showed you with the housing. That doesn't really even tell the full picture, right? Because when people upgrade their home, they're also upgrading what? Insurance, maintenance, and the big one, property tax. So it's not just that increase in the price in the mortgage, but it's also the increase in the maintenance. Now, I have a friend of mine that told me that this is the insanity in the market. She has a friend that went and bought I think it was 2,000 square feet for $600,000, just a basic builder, grade house. And she said, why are you doing that? She says, this is an inflated market. And she says, no, real estate will always go up. It'll continue to go up because people need housing. That's not accurate. That is not accurate in any way, mean, or shape. Now, that's what a real estate agent would like to everybody believe, but it's not accurate. Why? I've been through this before with a crash of 86 in real estate. I've been through it with a crash in 2006, 7, and 8. And here's what people do. They huddle. They combine. They downgrade. So if they're in a $600,000 house and now they can't afford that, because now everybody's run out of money, they go back to work and maybe their wages are decreased, or they don't need them at that high a wage because they can hire somebody else to come in. And now they cannot afford that house any longer. Then what they do is they huddle or they downgrade. Downgrade means they let the house for $600,000 foreclose. And then what they do is they get 2 or 3 of their friends and they rent one house. And that methodology is exactly, or experience is exactly what I predicted back in 2004, 5, and 6. And it happened in 7, 8, 9. Why? Because I had been through it in 86 already and watched what human nature does. And it's just sometimes just the economics of the math. They don't have the money to survive in that house. They got to let it foreclose. So again, I do not believe that the real estate market will really correct until we have a depreciation of the free money that the government gives out, the reduction of the savings that people run through, and that will start to happen here in the next 6 months to 12 months. Now, I don't believe inflation is going to correct itself. What the Feds are doing right now is not having that much of an impact. How do you have that much of an impact when travel goes up and retail goes up, even though they've increased interest rates? And again, this stuff doesn't happen overnight, but you'll see my algorithm says that real estate will really not start really popping down. Now, I'm on all these alert systems, and I see the houses that we're looking at investing into, which is Lake Coeur d'Alene, Bozeman, Whitefish, Sarasota, Florida, Miami, Florida. These are all hot spots that I'm watching to invest into. And the prices in certain areas, like Bozeman, Lake Coeur d'Alene, they're not going down. They're not hit yet. But Sarasota, Florida, Miami, that's starting to come down. Every day I see price decrease. So you're starting to see these dynamics go to work, but they're not all going to line up. What I don't think a lot of people understand, this is not like the stock market where you have day-to-day pricing. In housing, you have to make better predictions on productivity, savings, mortgage, supply and demand, etc. Okay, which we'll cover in a second here. But I do not anticipate that really being a good circle of opportunity until mid to end of next year, because I think that that's the time, the gestation time. Now, again, the midterm elections, originally the Republicans were leading that. Now they're not. And Manchin has signed on with McConnell, and they've done $363 billion in green or climate control. Now, I'll tell you about a couple good opportunities that I'm seeing. One, they've extended the period of time, not retroactively, for the solar housing tax credit. You can take up to a maximum of 30%. There's no refund backwards, but you can carry it forward. And here's the other good thing about it. They've actually included battery backups. In the past, it was generally hard to package that together. And so if you had like a power wall, so if your solar went out, you've got this entire system that can last for days. That was hard to get the solar credit on, but now you can. So that's back in the bill. Again, the House is good with it. The Senate's good with it. It's going to sign. I don't see any blockage at this point. Manchin was the only blockage. Second thing, and this is a really big opportunity. You may be an EV fan, you may be a gas fan, you may be a hybrid fan, but let me give you an opportunity that's here now. They passed a new law that says that as long as you order an EV car, now it could be a hybrid too, then you will be entitled to the tax credit in the year that you order it, not in the year that it's delivered. The government has recognized the shortage of rare minerals that are needed for the battery production, in addition to the log jam and the supply delay. And so here's what I'm getting to. You could order, now you got to make sure that the company that you order it from has EV credits left. Last time I looked, the government said, as long as there's not more than 200,000 of those cars sold, there's still EV credits, but they run out of the credits. So I know like right now, Toyota's done. They've had the Prius for years, right? GM is done. I think Ford is done. But check into that before you take this idea. But what you can do is you can put $1,000 down. You could order a Rivian. And if you ordered it in October, November, it may not be delivered until October, November of next year. But you can take the physical $7,500 tax credit. So let me explain what I'm getting at. You put the $1,000 down, and it's going to take a year plus to manufacture that car and take delivery of it. And you get $7,500, not in a deduction, but a physical refund, $7,500 less in tax. That's different than a deduction. But you don't have to pay for or buy the car for an entire year or whenever it's delivered. So I know there's a couple companies out there like Fisker has one, Jaguar has one, Rivian certainly has one. There's another one, I think it's Evoque or LQ or something like that. Anyway, it's an opportunity that I think you should look at, especially with the way that inflation is going, and I don't see a free up in car pricing right now because of the material shortage and labor shortage. So there's the distinct possibility that you could buy that car and you could resell that car for the same, if not maybe more than what you actually bought it for. As long as you take delivery of it, you get the $7,500 tax credit. Anyway, moving on. That's something that's coming up in the midterms, and we'll have to see how that plays out in the midterms, because that could change me to a version 10 on my econ map. Okay, and the last is I'm throwing my circle of opportunity there for real estate, not until mid to end of next year. Now, again, when I get to my actions, I'm going to tell you that real estate is not, the warning on real estate is not necessarily for exchanging. I'll go through that with you. So first, actions to take now. Do not reduce stock. Please don't do that. Stock tax loss harvest right now before the market does come back, because now is the opportunity to take advantage of those losses. Compute your cash needs for the next 5 years and make sure that you have the right buckets. That's just given. If you're working with us, we're doing that for you. And don't invest in real estate. And here's my little disclosure. Personal transitional real estate is acceptable. Now, I still want to put the warning out there. You may be just burying yourself with maintenance costs. But let me give you an example. Let's say that you bought a house in Las Vegas or Florida or somewhere that has a homestead law, California. It says that if you bought the house 10 years ago, they can only increase your property taxes by X% off the original, which might be 3%. But your real estate might have gone up 6, 7, 8, 9, 10. So you could have bought a $100,000 house 10 years ago, and you might be paying $1,000 a year for property tax, right? Then. And now you might only be paying $1,300 a year in property tax. But if you were to rebuy that house from $100,000 to $400,000 today, you might be paying $6,000 a year in property tax, in addition to an increase in the insurance because of the value. However, if you exchange a house, so let's say you have a house in Las Vegas and it's $500,000, and you sell that, you buy a house in Boise or wherever it is, and that's $500,000. Well, you're not really taking the downside of the real estate crash, because if you would have stayed in Vegas, it would have dropped 20%. Boise dropped 20%, whatever it is. Where the real difference is in the maintenance, insurance, and tax, because all those get reassessed when you buy the new house. So you just have to account for that is something that will still take a loss upon a real estate depreciation. Now, I'll give you a little secret. If we see the real estate crash that I'm anticipating, we go back and argue with the property appraisers and assessors and get property tax reductions. So that's one of the offsets. Unfortunately, the insurance companies, there's not much you can do there. They kind of rook the system. Anyway, let me wrap it up today. And if you have not yet or told somebody that you love or know about the Wiser Retire channel, just tell them, Google Wiser Retire on YouTube. They're going to get this channel. This channel is really devoted for more people that are in the accumulation stage versus the distribution phase, okay? And if you're not yet a member meaning you've subscribed to this channel, just Google H&H Financial Center on YouTube. You're going to see this page in front of you here. Just hit subscribe, and you will start to get notifications. Now, again, we're still trying to diagnose what happened to these last 2 weeks. I did do them. They were uploaded. It said scheduled, and I don't know what happened. But we will diagnose that, and hopefully, all tech gods willing, this broadcast today will be up online. And enjoy your weekend, and we'll talk to you next week.